Hello and welcome to the Harwood Report, presented by Trade Academy. It is September 17th, 2017, and I am your host and the founder of Trade Academy, Keith Harwood. Standard disclosures: all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Trade Academy is not an investment advisor, not registered with the US SEC, not registered with FINRA. Make sure you read the disclosures, but the key point here is that none of this is trade advice. It's all for informational purposes only. Before you enter into any trade, you should do your own due diligence. This week's highlights: we're going to go over the normal equity indices, S&Ps, NASDAQ, Russell 2000, Dow Jones. I think there actually may be a little bit of a trade there in the indices, so we'll get into that as we get into the trade ideas. Forex, commodities, and interest rates. Still looking at dollar yen. I think that's been a very interesting trade, and its impact on gold and silver in particular, very interesting. We're going to look at a potential trade in SLV. It's got a really interesting setup with volatility where it is. We're also going to dive a little bit into oil. So we'll look at both the future and the ETF, because I think they both tell a similar story, but when you look at the moving averages, there's a little bit of nuance there that I think is important. Finally, we'll go into some sector indices and potential trades in the energy index, utilities, and retail. So without any further ado, let's get right into it. First things first, I want to look at fear and greed. So a few weeks ago, I noted the fear and greed was getting down below 20, and that's about as extreme as it could get. Made me a little bit more bullish. Right now, I'm a little bit cautious because we're getting close to 80. The overall trend is still higher, but we have to be careful because fear and greed above 80 has actually shown pretty good signal that we're at least going to be consolidating and potentially pulling back. You saw last time we got above 80, we did have all that pullback. A lot of this was North Korea driven. This time, North Korea didn't really have an impact on the S&Ps this last couple weeks. They continue to test missiles. Nobody cares anymore. That becomes actually a little bit of a flag for me. A little bit too complacent potentially, but until the charts show us the turnover, you kind of have to just continue to ride them out. So it's more of a flag than anything, but it's getting pretty close. So I don't necessarily want to be overly aggressive, expecting the market to explode higher. That said, we have a Fed meeting this week. They can always say exactly what's needed to be that spark, either up or down in this market. So we've got two big things for me that are outside of the charts that I'm watching. One is fear and greed. Number two is the Fed. And on Wednesday, when they have their press conference, that's where I think that the market could really take some cues, and you got to be really on your toes Wednesday afternoon. So let's go to our first chart, S&Ps. Sorry, that's showing oil right now. Let's go to S&Ps. There we go. We're on the S&Ps. Friday looked like it was a little bit weak, but when you look at this chart, that's because this chart does not recenter for the dividend. So the S&P's SPY ETF paid out a dividend on Friday when ex-div. That dropped the price by about $1.24, I believe it was. So really the close would have been a little over 250, 250.43, which would be a new all-time high. So S&P's at all-time highs, continuing higher, looking pretty good here. Until you get a break below the 10-day moving average, I don't think you need to do too much worrying. But that said, we may just chop. You make a new all-time high, you want to play from the bullish side in general. I'm not going to do it in S&Ps because there's just not that much excitement in big ETF like that for playing for new all-time highs when you're already there and kind of been playing some tight ranges recently. QQQ, very similar story, sitting at new all-time highs. Had a little bit maybe of a bull flag here. Again, 10-day moving average is the key. As long as we're above that, we look pretty good. And even when you break the 10-day moving average, it doesn't necessarily mean we're going to stop going up. It just means we're going to stop. You got to get a little more than anything. You really have to get below the 20-day moving average to start making it look weak. IWM, though, is a little bit interesting. So IWM is a little bit firmer the last few days, and it's been really holding the 10-day moving average well, pulling up the other moving averages here, and you can see that the 20-day moving average is actually still below both the 50 and 100. The 200 is at the low point here. It seems to me that if this market is going to continue rallying, it's got to start coming from the small caps. Usually when markets get euphoric, small cap stocks go. Usually when we start seeing new all-time highs, small cap stocks start getting a little bit of that money flow. And you've had some stuff going on with oil, retail. These should actually be beneficial to the small caps. Oil in particular, as commodity prices start to come up, some of that's been a pretty good sign for firmness for the small caps. Retail names that have been weak. If you start getting a little bit of strength there, that actually tends to give a little bit of strength to small caps. So I think there's some things behind the small caps that are looking good on the charts for those sectors, and so that could make small caps a little bit more of an interesting story this week. And as such, that's going to be our first little trade idea that I'm looking at. And a couple things to note here. First off, we're going to look at the volatility. So we looked at the chart. We think that maybe, if all goes well this week with the Fed, we can make a new all-time high. All-time high, 144.15. Sorry, 144.25. 144.25 was the all-time high at the end of July. Of note, July 25th and 26th was the last Fed meeting. IWM had some weak performance after that, so that's something to be cautious of on Wednesday. But before it did have that weakness, we did make a new all-time high from previous levels. So you see this was going into that week, the 21st. We did pop up into the Fed meeting and then start to fade. I wouldn't be surprised to see us pop up towards 144 into the Fed meeting. If we get there before the Fed meeting, I'm going to probably trim and then look to react to the Fed and react to how the markets react to the Fed. If we stay around here, the R&R justifies holding some long options. And this is because implied volatility is at an incredibly low level here, 10%. Realized volatility, yes, has been a bit low very recently on the 20-day historical. But if you look at the longer-term historical volatilities, we're really talking 11, 12% pretty reasonable. If you go much longer, there you go. You're around an 11%. So I think that we should have some little bit of volatility this week heading into the Fed, maybe with a little bit of euphoric type buying and get IWM to a new all-time high. You look at the 22nd, 144s are cheap at 19 cents, but that's still 10.5% volatility. They'll be a little cheaper tomorrow once data comes out, but I actually like the September 29th, the end of the quarter trade. This gives you a little bit more time. You can see that those 144s are trading around 9%. That's very vol cheap and very dollar cheap at 35 cents. New all-time high puts those basically 35 cents. And they'd be 25 cents in the money just testing the new all-time high. And if you get that next pop, all of a sudden these could be trading for $1 plus. So I think that's my play here. If we're going to get a new all-time high, I'm expecting to play out a little bit in the IWM 29th, 144 calls. Don't see a real need to go all the way up to the 145s just because you're probably looking to exit this trade even by Wednesday if you get that pop. And again, if you don't get that pop, I don't mind holding these into the Fed, knowing that if they do say the right things and IWM decides to pop, then these still go to potentially $1 plus. So I'm not that worried about holding these, even though I don't have an edge on the Fed. If I think that there's 50-50 odds of up or down, well, if in the up scenario I make triple my money, that's a good R&R. So I like these a lot as a way to play for leading into the Fed and then potentially holding through the Fed announcement, depending upon how the charts go Monday, Tuesday. Let's go back to the charts, though. After IWM, we have the Dow Jones Industrial Average. So the other thing to note here on Dow Jones, obviously, it's at new all-time highs. Obviously, it just keeps going higher. And actually, the last time we had a little bit of a consolidation was leading into the Fed again. And you see coming out of the Fed announcement, Dow Jones Industrial Average was very firm, rallied from 217 all the way up to 222. Then we had some North Korea concerns, pulled the market back to the 50-day moving average and then back to the rally. I don't see a valid reason necessarily to play the options in Dow Jones just because they're not as illiquid. But if you're thinking that the Fed is going to stay with the same rhetoric, then this is actually, you maybe look for some individual names in the Dow Jones Industrial Average that you can play off of. Maybe Boeing as a way to play for this continued breakout the same way that it happened last Fed meeting. All right, let's go over to rates and Forex. So we'll start with the dollar yen. It's going to be a big week for the dollar yen because of the Fed and because of what's going on in the charts. I always key in on that 10 and 20-day moving average. 2 weeks ago, it broke above the 10 and 20-day moving average and looked like the trend was starting to flip. Then it broke because we were heading into that potential North Korean missile launch. The missile launch happened last week. Nobody cared. And we also got back above the 10 and 20-day moving average, and we're really holding firm above them. Went above the 50-day moving average and closed above that. Testing the 100-day moving average, no close above that. This looks to me like we are going to just continue to drag higher, flip the trend, firm dollar, wheat versus the yen would generally indicate risk on. Bad for gold, bad for silver, increased interest rates, so you'd expect TLT to drop. TLT, of course, is going to be very much impacted by the Fed on Wednesday. So a lot of this stuff actually does lead into what's going on with the Fed. If the Fed says the right things and interest rates in the United States firm, they start talking maybe about potential for rate hikes. You got to assume that dollar yen's going to firm, gold's going to be bad, silver's going to be bad, and that's why we look at the next trade here, and that is GLD. As dollar yen has started to firm, gold has started to fade. It's below the 10-day moving average, but not below the 20. Remember, the dollar yen cross is above the 50-day moving average. 50-day moving average for gold is all the way down at GLD is all the way down at 121.60. That is 4% lower. 3% lower. It's a pretty big divergence potential there. So if dollar yen continues to firm and we get people starting to just get out of that gold that they were trading from the long side really since the beginning of July, we could get a real washout here. 121.5, maybe even down to 120. I like silver a little bit better though. It doesn't look as significant on the downside because you're already trading here, and the key moving averages are a little bit closer. They're all clustered around 16. But the key is gold breaks down 3% and silver breaks down, say, 5%. That puts silver below all these key moving averages. That's how you get the washout. Let's look at what happened here. April. We had that look of this similar type of look. We started to break. We got below the 20-day moving average. We got below the 200-day moving average and just completely washed out below that. So if you have that kind of move, I mean, we could see low 15s again in SLV. It's going to take a little bit of time for that to happen. But if the trend stays firm in dollar yen, silver has some significant downside here. So if I look at GLD, the other reason I like silver, so if I look at GLD options, implied volatility is around 11%. Looks pretty much into the middle of the range here, right? If I look at SLV, around 17%, we're a little bit closer to the low part of the range. And in particular, we are at the lows since really the beginning of July. So we're at 17% in silver, in SLV, 17.5%, and we're at 11.25% in GLD. It's a little bit cheaper, relatively speaking, and we also had a little bit better looking chart to me where it was a little bit weaker already. And so for me, I'm going to take this and look over to the October 13th, 16.5 puts. These play really well on a break to the 200-day moving average, which would be around 16. One standard deviation move out to October 13th gets you below 16, around 15.75. And if we start breaking a little bit faster and volatility stays where it is, I'm going to look to roll these 16.5s into the 16 puts. Do it maybe as a 1x2. So right now I'd be looking to buy these for a quarter. If we do a little bit of a slow break to 16 or a quick break to 16.30 but volatility doesn't change, I'm thinking I can lever up, get into more of the 16s, take a little bit of money off the table in the process, and have a really nice return profile for the break down to the lows that I was talking about there, which was, again, down maybe as low as into the 15.25 range. So I think we got a lot of downside to silver. It's very Fed dependent, as we've said a number of times. But I think there's a good R&R to being long some SLV, October 13th, 16.5 puts. And, you can look again right here. It's the cheapest ball on the board, and this is the cheapest strike on that expiration. So I really like those 16.5s for that reason as well. Final commodity play. Let's look first at crude futures. Crude oil has done very well recently in terms of crossing the key moving averages. You had one weekday and then it just has been firming, bouncing off of all those moving averages. Now above every key moving average here, all above the the 10, the 20, the 50, the 100, and now above the 200, which was the highest one. We had an inside day on Friday, looking for a breakout to the upside here to confirm that this trend is still good and that above the 200-day moving average is the right place to be. The problem we have with the 200-day moving average in crude is the continuous contract. There's a roll in there in crude. The average long, more than likely, is actually below the 200-day moving average. So USO rolls their contract and helps to offset that contango. So we don't necessarily see quite as much strength when we take a more continuous contract look at crude oil. It is below the 200-day moving average at 1042. So we're about 2% below. It's basically a buck in crude. Crude's trading around 50. You get above 51. USO gets above the 200-day moving average. If the next dollar move in crude is lower, we're going to be testing against the 10-day moving average. This is my tight window of how I want to watch this. That if the next dollar move is up, the sector, energy sector names, energy producers, energy exploration, OIH, XOP, XLE should all be very firm. If the next move is lower, they should all be weaker. Last time we got above, really, all these key moving averages. We tested it here, and then we had a collapse. So we're going to have it get above and hold above, so 51, 52, and really look firm there, and not have an over-exuberant bullish oil commentary coming out in order to make that hold. But just to move to above 51 in crude, and I think we've got some interesting upside to XLE. So we get above 51 here. We're testing up some of these highs. Then we get to XLE. I think we could press towards the 200-day moving average quite easily. So you look at where we were in April. April 10th, crude XLE trading around 71 bucks. That time, crude is trading around 52. 53, and USO is trading all the way up at 11. So remember, the continuous contract says at 11, but if you're looking at the future earnings potential, you do also need to look at the spot price. We also have Brent in backwardation now. It's another key thing. The front month contracts are, I think, about 50 cents higher than 7-month out futures. So there's some desire for crude right now, which means that these XLE names should continue to firm. Last week I was thinking you test this 100-day moving average and fail. We didn't fail. Now I think you may have to test that 200-day moving average. So I've got two levels I'm watching here. Again, this is much like the SPY ETF. This break on Friday was mostly from XLE going XDiv. But if we test back, say, to 68.5 range, that's a pretty good upside from here. That's $3. That's almost 5%. On the other hand, if we can't hold above the 100-day moving average, then I would start playing for a move back towards the 62.5 range. So I've got two different potential plays here. I can look to buy calls as long as we hold above on Monday, and then know that if we break just that little bit, instead of holding the calls, I'll get rid of my calls and flip to a long put position playing for this break. But right now, as we're above, I'm going to start with the bull side. Part of the reason I like XLE is because of volatility once again. This implied volatility level is dirt cheap. Traditionally trades around 16%, currently trading around 12.5, 13. So we have very cheap options with a potential bull story that could get some people very excited in XLE. As I mentioned, this is also impacting the IWM concept. So if XLE does continue to firm, that's going to be better for my small cap trade. If small caps start to look weak and crude oil starts to look weak, then that cheap volatility is going to give me a really cheap entry into puts. But let's go to our expiration here. I'm going to look at pure October here. So a look at that 200-day moving average gets us pretty close to $69. I'm going to say we probably get a little bit shy of it. $67 calls, around 55 to 60 cents. They could go to $1.50 on a move to 68.5 over time. If your average daily move is about 0.75%, then this option, which expires in 5 weeks should get you about a 4% move. 4% move is right around 260. It gets you to 68.5. So the one standard deviation move in the October 20th expiration and the 200-day moving average get you right around that 68.5 level. So as long as crude looks firm, I'm looking at these October 67 calls. And again, as soon as we start looking weak, if we get below this key moving average, the 100-day moving average again, I'm looking to the bear side instead. I'm going to stay with the October expiration. That way I have some time to play it out, but I'll be looking at the 64 puts instead, about the same price, looking for a move back down towards maybe 62.5. So it's kind of the same type of R&R. But right now I think the higher probability is that we're going to test that 200-day moving average because we're above all those other key moving averages. So I'm starting with these calls. Then if that doesn't work, sell these out and look to these puts instead. That's my XLE trade. Let's look at the utilities. Utilities have kind of traded on this concept that interest rates are low, and so people like to buy utilities for the dividend yield. So if Miss Yellen on Wednesday starts talking up the idea of interest rate hikes and interest rates start to rise further, well, guess what? Utilities should probably be a little bit weaker. It's been a while since we've really had a down move in the utilities. So this nice long trend since the beginning of July, all the way here to make a new all-time high on September 11th. Let's look at what happened back here in June. June 12th, 13th, 21st right here. We closed below both the 10 and 20-day moving average. Chopped around for a few days and then started to break. And we got below the 100-day moving average before firming again. I wouldn't be surprised to see something like that happen again. I'm not necessarily targeting a move below the 100-day moving average, but I think we should test it. The 100-day moving average is just above $53. So if Ms. Yellen says the right things or the wrong things, go into the September 29th options, look at the 54 puts, see that they're about 15 cents mid-market. If we test the 100-day moving average down at 53.25, those are worth 75 cents just off of intrinsic value. That's a really solid R&R, 5-1. If Yellen says nothing and Utes don't move, it doesn't work well for this trade. If Yellen says the wrong thing and Utes start to rally and interest rates fall again, obviously it doesn't work for this trade. But you got 5-1 if she says the stuff that is needed to get interest rates to rise and utilities to fall. So this is one of the sectors that I actually like as a play on the economy is good enough to start talking an interest rate hike and the stock market fades as a result of it. There's nothing saying you have to stop at 100-day moving average. You could easily go below. So what I'd look again, similar to what I was talking about in silver, is you try to buy these around 15. If she says the wrong things and these collapse and yet volatility does not come up, you're going to roll down to the 53.5s, or I'm going to look to roll down to the 53.5s. But remember that these only have 2 weeks to expiration, so you've got to have the move happen relatively quickly and relatively violently. Remember volatility levels here. Cheap, 9%. You could easily get to 13. And on a move down towards 54, below 54, I think we're going towards 13%, and these are only priced at 10.5%. So yes, there is a skew here. It's a relevant skew. It is a skew that should exist. You don't want to go all the way down to the 53s or 53.5s. Not enough time to expiration, and they actually have too much skew to them. I'll start with 54s, potentially roll down just because of how the market reacts on Wednesday afternoon. And finally, XRT. So remember, I was talking about fear and greed at the very beginning. We're at 77. 80 has been a high point. It has been hard for the market to continue to rally when fear and greed gets to an extreme greed situation. Well, I think that retail names should roll over aggressively if the market gets that move and then fades. But right now, much like energies, we're above the 100-day moving average and really look like we're going to drive to that 200-day moving average. That's not very far away. There's not a lot I can do in terms of buying here to target an 80-cent return. It's 2%. Volatility doesn't really price itself here for planning for a 2% move. So what I prefer in this case was looking at two potential bearish entries. Number one, if we test the 200-day moving average, I will see if I can actually fade that move with some puts as long as volatility is cheap enough. Playing where my real edge is saying that at that point, if we get above 42, get that kind of move, that last bit of a move here in the retail, that we're probably at that extreme bull status. The market's probably looking for some sectors to sell off a little bit here. There's a little bit too much length in the market at that point. So move to 42 here. I'm looking for a potential bearish entry. Alternatively, I'll break up the 100-day moving average and I'm looking for that bearish entry, just like in XLE. So where am I going to play that? Well, right now, going out to October 13th, cheapest volatility on the board. I really like the potential for a 41 put. Into a rally of 80 cents, these should come down, probably down to about 40 cents. And the downside on that rollover should push us down below the normal key moving averages, so maybe down to 39.5. So if I'm buying these puts for 40 cents with a potential downside, we'll move to 39.5. Got 4-ish to 1, 3 to 1, 4 to 1 R&R. It's a pretty good payoff potential. Alternatively, if we break, can't hold the 100-day moving average, we're going to be trading just below 41. In that case, I got to go a little bit lower. I have to look at the 40.5 puts, maybe even the 40 puts, and I may end up still paying that 40-cent price. So it's not going to give me quite the same leverage. But I'd look at the 40 puts, and into that break, sell some 39s against it. This is something that you can actually play as a nice tight put spread. Maybe you may end up paying closer to 40 cents on the 40 puts, but then on a 50 cent to $1 break, you could sell out these 39s for 30 to 40 cents and have a really tight put spread that still has a good return profile on a break towards 39.5. So remember that there's nothing stopping this at 39 necessarily. So if this rollover happens faster, you could easily get down towards 38.5. So those 40 puts could certainly pay off on their own at 40 cents, but it's a little bit worse R&R. So overall, I still like it, but I prefer the opportunity in XRT if we can get it on a rally to the 200-day moving average and then fade that move. So to recap, IWM, I like the calls heading into the Fed announcement. If we rally into the Fed announcement, I'm looking to exit. Dollar yen, I expect to continue firm into the Fed announcement. Yes, obviously Yellen's conversation, Yellen's talking points will have an impact, but at current levels, at the current direction this is going, I'm looking at bearish plays in silver. On the other hand, crude and USO, these are going to dictate really my move in XLE. If the oil market continues to firm, we're going to look at calls. If the oil market starts to break, we're going to look at puts. XLU, we like those puts because of the potential for a move down to the 100-day moving average. This is kind of the opposite of the IWM idea. It's right now, it's just got a really good R&R, and if Yellen says the right things, this could break pretty aggressively. If Yellen says the right things, we could also see this rally aggressively. So we've got some cheap optionality here for a new all-time high or a big break. And finally, XRT, we're looking for ways to get short here. It's going to either be into a rally to the 200-day moving average or on a break of the 100-day moving average. So I like some of the setups here. Volatility is obviously very cheap because we're near highs, and that gives us a lot of ways to play with options. Contact me. Again, you know the website, tradeacademy.co. Email keith@tradeacademy.co. Call me, 312-600-8004, or... and finally, follow me on Twitter, @TradeAcademyCo. As always, I continue to post watch lists and some trade ideas midweek. I'm going to be keeping an eye on stuff, and I'll post some stuff as we get a little bit more clarity from the Fed and the new key moving averages, volatility, etc. as we go through the week. So it's going to be an exciting week, folks. Hope we're all ready to trade it up.